Hey everyone, and welcome to this explainer. I'm so thrilled to have you here today because we are tearing into a company that has Wall Street analysts completely, and I mean literally, divided. We're looking at Vale stock. Today we're going to uncover 14 crucial flags, 7 red, 7 green, and then we'll run it all through 3 legendary investing frameworks to find the hidden truth behind the headlines. If you're a focused learner looking to just cut through the financial noise and see exactly what the mainstream media is ignoring, well, you are definitely in the right place. We've got a lot of ground to cover, so let's set a fast pace and get right into it.
Right off the bat, get a load of this sheer contradiction. On one hand, you've got Wall Street absolutely cheering because Vale's just reported $10.5 billion in revenue. That's up nearly 20%. And naturally, analysts are busy raising their price targets based on that top-line growth. But wait a second, look at the other side. Their net income didn't just stumble, it completely fell off a cliff, registering a massive one-time loss of 266 billion reais. So, we've got revenue skyrocketing while the bottom line is totally collapsing. This is exactly why you need to think twice before blindly clicking buy just because you read a flashy revenue headline.
So, here is our roadmap for today's explainer. 1. Meet the mining giant. 2. 7 major red flags. 3. 7 massive green flags. 4. Testing the value frameworks. And finally, 5. The final verdict. All right, Section 1, Meet the Mining Giant. What exactly is Vale?
For those of you who might not track the commodity sector every single day, Vale SA is an absolute behemoth. Headquartered down in Brazil, it's a $60+ billion mining giant. But they aren't just any miner, right? They are literally the world's largest producer of iron ore. And on top of that, they're a massive supplier of critical minerals like copper and nickel. Now, institutional investors absolutely love this company for its sheer scale, and historically, its dividend has been incredibly generous. But, as we just saw with that earnings contradiction, beneath this really impressive surface, there are some serious warning signs that most analysts are just brushing aside.
Okay, let's dive into those warnings. Section 2, 7 major red flags, the bear case. Let's step right through these first 4 major warnings. Red flag number 1, profit quality is deteriorating. Like we talked about a minute ago, 20% revenue growth means absolutely nothing if you're posting massive net income losses. That's what we call profitless prosperity. Moving to red flag number 2, their dividend is heavily debt-fueled. Vale has been paying out these generous yields and buying back stock, but a genuinely scary amount of this is funded by debt, not sustainable free cash flow. When commodity prices drop, that strategy instantly falls apart. Red flag number 3 is boardroom chaos. They're experiencing some rapid board turnover. Look, for a global company with massive regulatory exposure, governance stability is absolutely crucial, and rapid changes usually mean execution suffers. Finally, red flag number 4, missing earnings estimates. They recently missed EPS by 12.2%, and before that, it was a 13.7% miss. 2 consecutive misses tell us management is either losing its grip on operations or they're just deliberately overpromising to Wall Street.
Now, I really want you to focus on this exact number, 1.62. This is the Altman Z-score for Vale, and it acts as our red flag number 5. If you aren't familiar with it, the Altman Z-score is a highly respected formula used to predict bankruptcy risk. A score of 1.62 puts this $60 billion company squarely into the distress zone. Now, it doesn't mean they're going bankrupt tomorrow, no way, but it is a massive flashing warning light that the financial stress inside this company is very, very real.
Building on that distress zone signal for flag 5, let's round out the bear case with our final 2 red flags. Red flag number 6, operating margins have been falling for 5 straight years at a compound annual growth rate of 12.4%. Just let that sink in for a second. This isn't just a seasonal dip. This is a structural, continuous erosion of profitability. And red flag number 7, shrinking revenue combined with growing investment. Vale is pumping massive capital expenditures into the business even as the top line contracts. When a company overinvests during a decline, well, that's a textbook recipe for future asset write-downs and serious value destruction. But hey, it's not all doom and gloom. Let's shift the energy here. Section 3, 7 massive green flags. The bull case.
Green flag number 1 is defined by the single figure, $21.30. This is Vale's C1 cash cost per ton of iron ore. So why does this matter so much? Because it is the absolute lowest production cost in the entire industry. They can produce iron ore cheaper than competitors in India, China, and major rivals like Anglo-American. Basically, even if global iron ore prices absolutely crash, Vale stays profitable because their floor is just so incredibly low. And this brilliantly illustrates how that world-class cost advantage feeds into our next 3 green flags.
Green flag number 2. Copper is their hidden growth engine. Vale's copper business just beat EBITDA expectations by a whopping 9%. With AI infrastructure and electric vehicles demanding endless copper right now, Vale is positioning itself perfectly. Green flag number 3. Operational execution. Despite all that boardroom chaos we mentioned, the boots on the ground are putting in the work. Production is beating guidance, with nickel coming in 4% above target and copper 3% above target. Consistently beating operational targets, that's a huge positive. And green flag number 4, an incredible economic moat. Guru Focus actually gives Vale a moat score of 6 out of 10, placing it in the top 0.27% of over 2,600 mining companies. Their scale, their brand, and those regulatory barriers are practically impenetrable.
Let's wrap up the bull case with our final 3 green flags. Green flag number 5, a Peter Lynch strategy score of 93%. Based on growth at a reasonable price metrics, a really strong balance sheet, and a low PEG ratio, the Peter Lynch framework absolutely loved this stock. Green flag number 6, it is incredibly cheap. The enterprise value to EBITDA multiple is sitting at roughly 5 times. You're essentially paying just 5 years of cash flow for this entire global enterprise. And finally, green flag number 7, a brilliant strategic transformation. Vale has been aggressively selling off its coal, steel, and fertilizer assets to focus purely on the future: iron ore, nickel, and copper. They are rapidly transforming into a specialized critical mineral supplier for the global energy transition.
All right, so how do we make sense of all this? Let's move to Section 4, Testing the Value Frameworks, the Guru Stress Test.
The real question is how the greatest investing minds would view this massive tug-of-war. Let's walk through it together. First up, Warren Buffett. He'd look at Vale and give that economic moat a massive pass. The man loves durable cost advantages, but he'd fail the price and be highly skeptical of that management turnover. His verdict? Not right now. Next, Benjamin Graham, the father of value investing himself. Graham would crunch the numbers and see that the stock trades above his calculated Graham number of $13.39. His verdict? It's overvalued with absolutely no margin of safety. Hard pass. Finally, Peter Lynch. Like we just talked about, his strict metrics give it a 93% score because that PEG ratio passes with flying colors. But here is the massive warning label. That score assumes earnings will actually grow, and right now earnings are shrinking. His verdict? Promising, but only if earnings can actually recover.
Section 5, the final verdict, weighing the scales. When you weigh the scales, you're left with this stark reality. On one hand, Vale is undeniably a high-quality asset. They've got an unmatched cost advantage, a top-tier economic moat, and a really compelling copper growth story that aligns perfectly with the future of global energy and AI infrastructure. But on the other hand, it comes at a highly questionable price. The profit quality is structurally deteriorating, the dividend is dangerously debt-fueled, and according to strict value investing standards, there is simply no margin of safety right now. So what does this all mean? Well, if you're a deep value investor looking for a total bargain, this just isn't it yet. The smartest move right now is likely to wait for a better entry point. Or, hey, if you believe strongly in the copper supercycle, you might begin averaging down in very small tranches to protect your capital.
And that brings us to you. Based on the 14 flags we've just uncovered and the Guru's stress test we ran, what is your verdict? Are you buying Vale? Are you selling it? Or are you waiting for a better price? I want to know, so drop a comment below with your specific strategy. If you found this breakdown helpful and enjoyed seeing what the mainstream media misses, be sure to hit that subscribe button, leave a like, and save this explainer to your watch playlist. Keep learning, keep analyzing, and I will see you in the next explainer.